If you checked your financial feeds this weekend, you likely got a bit of whiplash.
Oh, yeah, that is putting it mildly.
Right. I mean, today is Sunday, May 31st, 2026, and the global financial landscape is practically vibrating with volatility right now. We are seeing some truly dizzying, completely contradictory headlines just crossing the wires hour by hour.
It's a lot to process.
It really is. Like gold jumps 1.86% one day and then violently falls 2.57% the very next trading session. And then France's Mint launches this massive 4,000 euro solid gold investment coin aimed at everyday people.
Right, right, at retail investors.
Exactly. While at the exact same time, major digital assets like Bitcoin are stumbling significantly amid all these escalating global tensions.
Yeah.
It feels like institutional money is sprinting in 10 different directions at once.
Well, when you see that kind of rapid high-amplitude oscillation across asset classes, massive physical gold products launching into high retail demand while paper markets swing wildly, it points to a structural anxiety.
Like deep in the plumbing of the system.
Yeah, exactly. In the global financial system itself, institutional capital is trying to position itself for a paradigm shift, not just a standard run-of-the-mill market correction.
Okay, let's unpack this. Our mission for today's deep dive is to essentially cut right through that dense financial jargon and the panic-inducing marketing you see out there and just figure out the actual mechanics of what is happening under the hood.
Which is so necessary right now.
Yeah, we really need to evaluate the true stability of the US dollar, decode what these growing whispers of a macroeconomic currency reset actually mean in mathematical terms, and, understand exactly why gold has suddenly forced its way back into the spotlight.
To map that out properly, though, we need to rely on rigorous market analysis, not just standard internet doom scrolling.
Absolutely.
So our primary source material today is an exceptionally detailed analytical article. It's titled What Dollar Reset Talk Means for Gold, and it was published by the Gold IRA Company's Bulletin, authored by their lead researcher, Doug Young.
And Doug Young brings a very specific operational perspective to this, which I think is crucial. He's a former financial director with over 20 years of direct experience in the financial markets.
Yeah, he really knows the mechanics.
He does. He had a 16-year tenure managing capital at World Freight Services. And over the past decade, he's authored over 500 published research articles.
Oh, wow, that's extensive.
Right. He's also conducted more than 80 distinct valuations of gold IRA and precious metal logistics companies since, I think, 2011. So we are dealing with insights grounded in deep, practical experience here. It's not internet hype. We're looking at cold, hard market mechanics.
Which, honestly, is the only lens to use when analyzing a structural shift of this magnitude. You simply cannot understand the current aggressive price behavior of gold without first dissecting the underlying vulnerability it's specifically designed to protect against.
Which is the vulnerability of the world's most dominant currency.
Precisely, the erosion of the reserve currency.
So that phrase, currency reset, it gets thrown around a lot on the fringes of financial media, usually like right next to a pitch for survival food or something.
Yeah, the marketing gets pretty intense.
It really does. But structurally, what does a currency reset actually entail in the real world of international finance?
Well, it's a major restructuring of a sovereign currency's fundamental value and its role in the global market.
Okay.
And it rarely involves a dramatic midnight announcement where the old money is suddenly declared worthless. It's more about altering the underlying architecture.
What does that look like in practice?
It might involve a massive, coordinated devaluation to erase the real burden of debt obligations, or maybe a fundamental change in how exchange rates are pegged, or even a shift in the settlement layer of global trade.
Okay, so it's a systemic overhaul. What triggers that?
The triggers are almost always the same specific macroeconomic conditions. You're looking at mathematically unsustainable government debt, persistent structural trade deficits, prolonged fiat debasement, where the money loses its value over time.
And then ultimately, people just lose faith in it.
Exactly. A terminal loss of institutional confidence in that currency's stability. And if we connect this to the bigger picture, the historical data presents a very sobering reality check.
How so?
Well, the US dollar has operated as the unchallenged global reserve currency since the mid-20th century, right? Established by the Bretton Woods Agreement.
Yeah, back in the 1940s.
Right, and that status gives the issuing country immense asymmetric privileges. Primarily the ability to export inflation and borrow at artificially depressed rates. But structural history shows that dominant reserve currencies, whether it was the British pound, the French franc, or the Dutch guilder before them, They typically only hold that unipolar status for about 80 to 100 years.
Oh, wow. Wait, 80 to 100 years.
Mm.
And looking at the calendar from Bretton Woods in 1944, we are sitting directly inside that transition window right now.
We are exactly at the mathematical pressure point of that cycle, and the structural cracks are highly visible in the data today.
What kind of cracks are we talking about?
Over the past 20 years or so, the U.S. dollar's share of allocated global foreign exchange reserves, money held by central banks, has been in a sustained gradual decline.
Okay, so central banks are diversifying away from it.
Exactly. Furthermore, we're seeing major emerging economies actively establishing bilateral trade agreements that are settled in local currencies, effectively bypassing the dollar entirely.
Right, like exploring non-dollar trade settlements.
Yeah, they are building alternative clearinghouses and messaging networks to circumvent systems like SWIFT. That allows them to trade commodities without needing dollars to clear the transaction.
So it's not always like flipping a switch where the currency is suddenly worthless. It sounds more like a leaky bucket. You don't notice the water level dropping until you're suddenly thirsty.
That is a brilliant way to look at it. The leaky bucket analogy is spot on.
But the dollar is still the most widely used currency in global finance, right? I mean, by a massive margin. Is it actually losing its throne? Or is this just standard economic doomsaying designed to sell newsletters?
The dominance of the dollar is exactly why a reset doesn't happen overnight. But mistaking a slow transition for safety is a critical error.
Ah, okay.
The architecture is changing. The shift usually functions behind the scenes until a specific liquidity crisis forces it into the open.
So it's happening quietly.
Right. And by the time the massive currency shift culminates and the public actually becomes aware of the new rules of the game, institutional capital has already repositioned itself. History shows these massive changes usually come with very little advance warning to the general public.
That leaky bucket concept perfectly describes the most insidious tool governments use to manage their debt, which leads us directly into Doug Young's concept of the stealth default.
Yes. The stealth default is, I would argue, the defining economic reality of our current decade. It's entirely a function of inescapable sovereign math.
Walk us through that math.
Sure. When a government's aggregate debt level rises significantly faster than its underlying economic growth, meaning the cost to simply service the interest on that debt outpaces tax revenues, policymakers are backed into a corner.
Right, they have to figure out how to pay for it all.
And they have very limited choices. They can aggressively hike taxes.
Which drains capital from the private sector and halts economic growth. Nobody likes that.
Exactly. Or they can implement severe austerity and cut government spending.
Which triggers an immediate painful recession, also politically unpopular.
Right. They could also formally default on their sovereign bonds.
But that would trigger a catastrophic global banking crisis.
Precisely. So they take the unspoken fourth option. They just let inflation run hot.
Doug Young's analysis frames this persistent, elevated inflation not as an accident or a temporary supply chain glitch, but as a deliberate stealth default, right?
Yes, that's exactly it. Instead of a sovereign government stepping up to a podium and announcing, we refuse to pay back the bonds we owe you, they quietly expand the money supply. They allow prices to rise.
Okay, let's translate this to the listener's everyday life, because this is where the macroeconomic theory fundamentally alters your personal net worth. You're talking about the difference between nominal value and real value.
Right, exactly.
So your bank balance might stay the exact same on paper. You have $10,000 today, you have $10,000 next year. On paper, you haven't lost a dime, but the purchasing power of that cash silently evaporates.
They are mathematically eroding the real value of their own debt over time. They pay back every single nominal dollar they owe to their creditors.
Honoring the technical letter of the contract perfectly.
Yes. But the actual purchasing power of the currency they use to settle that debt has been intentionally decimated.
It's like someone borrowing $100 from you, and when they finally pay you back 10 years later, that same $100 only buys you a sandwich instead of a steak dinner.
Yeah, that sandwich analogy is entirely accurate. That is exactly what is happening. And that evaporation fundamentally shatters long-term financial modeling for everyday people.
Which explains the anxiety we see in the source's retirement headlines. I
Yep.
mean, we're seeing things like older Aussies remaining at work because their superannuation funds are losing purchasing power, or New York rolling back pension reforms, or headlines asking why the standard 4% rule is no longer safe for retirement. The system is inherently designed to quietly deflate our savings to save the government's balance sheet.
It becomes the only mathematical way out for them.
So if that's the case, how are the central banks themselves protecting their own wealth? because they are the ones executing this. They know how the math works.
What's fascinating here is that the central banks are actively executing the ultimate insider trade.
What are they doing?
While their policy statements often project absolute confidence in fiat stability, but their balance sheets tell a completely different story. They are heavily buying the very asset we are about to discuss. They are printing the paper while quietly backing up the truck to buy physical gold.
Let's examine that golden hedge. Why, after thousands of years of technological advancement, does institutional capital keep running back to gold during monetary stress?
It comes down to its structural position as a store of value. Unlike fiat currencies, which basically rely on a government's promise, an IOU gold is a bearer asset.
Meaning what, exactly?
Meaning it is not issued by any institution, it's not a liability on anyone's balance sheet, it requires no counterparty to make it whole, it's just a hard asset.
But the source material makes a crucial distinction here. We're not just talking about gold as a monolithic concept. There's a big difference between physical gold and paper gold.
Oh, that distinction is paramount. Retail investors misunderstand this all the time.
Break it down for us.
Physical gold refers to tangible coins and bullion bars. You hold it in your possession or in a private vault. Because it exists completely outside the interconnected web of the banking system, physical gold has zero counterparty risk.
And for clarity, counterparty risk is the hidden danger that the institution on the other side of your contract, like the broker or the bank, simply goes bankrupt during crisis and fails to honor their obligation to you.
Exactly. Now compare that to paper gold. These are financial derivatives like ETFs, futures contracts, or unallocated bank claims. When you buy paper gold, you do not own the metal.
You just own a promise.
Right. You own a fractional reserve promise from a financial intermediary. Many of these institutions use something called rehypothecation.
Which means they issue multiple paper claims on the exact same physical bar sitting in their vault.
Yes. So in a true systemic crisis, the liquidity of that paper gold market seizes up. The risk of the institution failing, that counterparty risk, becomes the primary danger, regardless of how high the spot price of gold goes.
Okay, here's where it gets really interesting, because I want to push back a bit. The moment we bring up systemic banking failure, it's very easy to slide into sensationalism.
Absolutely, which we want to avoid.
Right, and wait. The source explicitly warns that gold can be volatile, might underperform equities for long periods, and doesn't always go up.
It doesn't offer a yield either.
Exactly. So we shouldn't just run out and put our life savings into gold bars buried in the backyard, right?
Yeah.
How does a regular person actually use this information?
This raises an important question regarding asset allocation. You have to remember, the objective is strategic defense, not apocalyptic speculation.
Okay, so it's not a get-rich-quick scheme.
Not at all. Hard assets historically help preserve purchasing power during specific periods of fiat transition, but they are part of a broader strategy of diversification. Capital managers view physical gold as financial fire insurance.
So it's about practical steps over panic.
Exactly. We have to avoid the hype highlighted in the source, discard the myth that a reset will happen tomorrow.
Yeah, that overnight reset narrative is dangerous. You can't react to sensational marketing messages promising dramatic gains from a collapse.
Structural shifts take years, sometimes decades.
So what indicators should you, the listener, actually watch to monitor the situation objectively, instead of trying to predict a specific reset date?
Doug Young recommends watching 4 highly specific macroeconomic indicators. Number 1. Sustained inflation trends. You watch the sticky inflation, the structural cost of energy, food, and housing.
Right, and indicator number 2.
Government debt levels relative to GDP. You want to watch the threshold where the cost to service the interest on the national debt starts consuming an outsized percentage of tax revenues.
What's the third indicator?
Central bank reserve composition. Are they continuing to aggressively buy more physical gold while reducing exposure to U.S. Treasury bonds?
And finally, number 4.
International trade settlement patterns. Are major countries ditching the dollar for cross-border trade and using local currencies or alternative systems instead?
So what does this all mean? It's about being a weather watcher instead of a doomsday prepper. You look at the barometer inflation, debt levels, so you remember to bring an umbrella rather than abruptly moving your family into an underground bunker.
I completely agree. That analytical distance is crucial. In your money or your life topics like finance, you must rely on evidence-based info. Consult qualified professionals.
And look at your own portfolio.
Right. Ask yourself, how reliant are my assets on financial institutions remaining stable?
That's a great question to ask. Well, let's wrap up this deep dive. We've covered a lot of ground today. We started by understanding the roughly 80 to 100-year lifespan of a reserve currency.
Which puts us right in the transition window.
Exactly. Then we explored the quiet erosion of your purchasing power via the stealth default. And finally, we dug into the nuanced reality of physical versus paper gold as a hedge against counterparty risk.
It's all about understanding the mechanics.
It really is. For listeners who want to explore this topic further and review the research platform we discussed today, you can visit the Gold IRA Company's Bulletin website. That is at goldiracompaniescompared.com. Let me spell that URL out clearly for you. goldiracompaniescompared.ad.com. We've also put a link to it right in the deep dive notes.
And as we close out, I want to leave everyone with a final thought to ponder that builds on our source material today.
Let's hear it.
If physical gold's primary superpower is its lack of counterparty risk and its independence from central banks, what happens when digital assets and blockchain technologies, which are mathematically designed to do the exact same thing, reach full maturity?
Oh, that's interesting.
When the current 80-year reserve currency cycle ends, will the ultimate safe haven of the future be a heavy metal you can hold in your hand or a decentralized piece of code you can't even touch?
That is a phenomenal question to think about. Well, thank you for joining us on this deep dive today. Stay curious, keep tracking the data, and keep questioning the headlines. We'll catch you next time.